Coming up here on Global Business, China's top economic planner will roll out another 62.5 billion yuan in consumer goods trade-in subsidies by the end of June. 6 months into the Hainan Free Trade Port's island-wide special customs operation, zero-tariff imports have surged some 120%. And the Bank of England held its key interest rate steady at 3 3/4%, judging inflation pressures too unclear for a premature hike. And welcome everyone to Global Business here on CGTN. I'm Michael Wong here in Beijing. And we begin with consumption here in China, as the country's National Development and Reform Commission is releasing another 62.5 billion yuan by the end of this month, all as a part of its ongoing consumer goods trade-in subsidy program. Now, this would be the third batch of funding in a scheme designed to get Chinese consumers spending again on everything from fridges all the way to smartphones. So far, the Chinese government has issued over 185 billion yuan in equipment upgrade funds in 2 batches, supporting over 11,000 projects with a total investment of more than 840 billion yuan. Now, from January to May of this year, 125 billion yuan has been allocated for the first 2 batches of consumer goods trade-in subsidies, which has already driven product sales of over 820 billion yuan, benefiting more than 110 million people. And China is set to launch a new initiative aimed at boosting new energy vehicle sales in rural areas, featuring improved trade-in services and reinforced policy support. The initiative, announced on Wednesday by 5 government departments, including the Industry and Information Technology Ministry, will select reliable models that meet rural needs while implementing purchase tax and vehicle tax exemptions. Dedicated trade-in stations will be set up during that campaign, allowing rural consumers to apply for subsidies when switching to NEVs without quantity restrictions. Sales outlets, maintenance providers, charging services, and financial institutions will also collaborate to improve the overall NEV usage environment in rural areas. Now, since the very first rural NEV campaign back in 2020, over 500 models have been promoted across 10 batches through the end of last year. Well, people across China are already celebrating the Dragon Boat Festival, also known as the Duanwu Festival, which falls on Friday this year. The country also expects an increase in travel over the holiday period. China's railway network is forecast to handle about 83 million passenger trips during the 5-day travel surge around the Dragon Boat Festival holiday. The travel rush period runs from Thursday to Monday, with Saturday expected to be the peak day at roughly 19 million trips. Now, to accommodate this travel surge, the railway operator has rolled out a peak hour schedule with around 13,000 passenger trains running daily on average. Overnight, high-speed trains will operate on major high-speed rail routes such as the Beijing to Shanghai route, Beijing to Guangzhou, and Beijing to Harbin lines. And as China gears up for the Dragon Boat Festival holiday, destinations across the country are turning traditional customs into tourism draws, helping boost travel and consumer spending.
In the northern city of Harbin, cooler summer temperatures, dragon boat races, and cultural events are attracting visitors ahead of the long weekend. The city's annual dragon boat competition is already drawing crowds.
Hosting this race every year is a great way to keep traditional Chinese culture alive.
Local authorities are also rolling out tourism vouchers and festival promotions to encourage spending. Across Heilongjiang province, businesses are putting a creative spin on zongzi, the traditional rice dumpling eaten during the festival, offering everything from local specialties to new flavors aimed at tourists.
The flavors are really unique. It was surprisingly delicious. I'd love to take some home for my family and friends.
Further south in Guangzhou, attractions are launching Dragon Boat Festival-themed shows and interactive experiences as holiday bookings pick up.
Traffic on our official platform is more than doubled from a year ago, and ticket bookings have increased by over 10%.
From dragon boat races and live performances to local food and cultural attractions, holiday destinations across China are betting that tradition can be a powerful driver of tourism and consumption.
And today marks the peak of China's 618 e-commerce shopping festival. And market observers say this year's event signals a transition from prioritizing scale to emphasizing value. E-commerce platforms this time have scaled back their race to claim the lowest price online. At the same time, vendors are moving from an emphasis on sales volume to profitability, now taking a more prudent approach to safeguarding their bottom lines. More striking is AI's rapid rise, as the AI engines of China's tech giants JD and Alibaba both gain widespread traction. Meanwhile, short video platform Douyin is seen providing more computing resources to vendors on its e-commerce platform to enhance customer service, business operations, and decision-making. All right, in other China headlines we are tracking at this hour, China's market regulator on Wednesday unveiling a draft rule to curb food delivery platform subsidies, targeting price wars and what they call irrational competition. The proposed measures would ban platforms from shifting subsidy costs to merchants, leveraging capital for monopolistic practices or selling below cost. 7 Chinese agencies have jointly issued an action plan to boost platform economy collaboration. That plan focuses on computing power pooling and interconnection, building a national integrated computing power monitoring, scheduling, and service platform while lowering SME barriers to accessing token-based services. And 8 Chinese agencies have released an AI plus consumption plan with 17 measures spanning goods, services, and business innovation to tackle supply-demand mismatches and accelerate AI adoption in homes and businesses. All right, time for a short break. Still to come here on Global Business. 6 months into the Hainan Free Trade Port's island-wide special customs operation, zero tariff imports have now surged some 120%.
Supply chains. How China and the world are working together to make them more resilient than ever. Closing gaps across links, connecting consumers, businesses, markets, and nations. This June in Beijing, the 4th China International Supply Chain Expo brings the world's leading experts and companies together in one place. Watch CGTN for comprehensive coverage of the latest trends in technology. June 22nd to June 26th, only on CGTN.
Well, today marks 6 months since southern China's Hainan province began its island-wide special customs operation. The latest data shows zero tariff imports at the Hainan Free Trade Port soared some 120% from a year ago by the end of May. Now, during the same period, Hainan's goods trade surged nearly 55% year on year. The Free Trade Port is becoming increasingly attractive to businesses, with the number of new business entities jumping by over 61% during the 6-month period. Well, in an era of global uncertainty, one tropical island in southern China is indeed becoming a case study in open trade. Hainan, the largest free trade port in the world, is China's answer to a pressing question. How can a nation use a single pilot zone to rewrite the rules of global commerce? Our reporter Xu Yi has the story.
For raw coconut farmers like Budi and Ari, in the past, it took at least 40 days for their fruits from Indonesia to Hainan. But in cross-border trade and logistics for fresh fruits, speed is everything.
In Indonesia, raw materials for coconuts are still relatively easy to obtain, with a stable and abundant supply. But long shipping cycles take a toll on the fruit's quality.
And now, thanks to Hainan's new direct sea route for raw coconuts from Indonesia, transit time has dropped to just 7 days, boosting freshness and supply chain stability. And they'll never worry about the long shipping.
Not just coconuts, Hainan is a key gateway for tropical fruits like durian and mango from Southeast Asia into Chinese market. And beyond fruits, Hainan witnesses over 800 million yuan worth of goods flowing in and out every day, linking it to more than 220 countries and regions. So how does this island gateway cater to the ever-growing cross-border trade with convenience and security? The Hainan Free Trade Port gives the Chinese solution. On the first day of the special customs operations launched in Hainan, at Haikou Meilan Airport, a batch of chocolates produced locally in Hainan using imported raw materials passed swiftly through customs clearance. At the second line port of Hainan special customs operations, the clearance process took just 2 minutes.
On the first day of the special customs operations, this batch of our Hainan chocolate is being shipped to Shaanxi. We didn't expect the customs clearance to be so fast. For our company, time efficiency directly translates into maximizing profits. And this company is one of the first enterprises to benefit from the dividends of Hainan Free Trade Port's special customs operations, which represents a major strategic shift in Hainan with the core framework of freer access at the first line, regulated access at the second line, and free flows within the island. At Yangpu Port, a critical checkpoint in Hainan, a historic transformation is also underway. This batch of 4.8 tons of soybeans will be transported to an oil processing enterprises near Yangpu Port. It will benefit from the value-added processing tariff exemption policy. Since 2021, this policy in Hainan have saved around 300 million yuan in tariffs for this firm. And Yangpu Port has also given Zhanghui's exports a significant boost.
Yangpu Port is an international hub here with many direct liner services to various countries, making logistics highly convenient. Thanks to this, our first batch of export goods was completed within just 7 days, a process that previously took 1 or 2 months, or even longer. This has laid a solid foundation for our export operations. Our products are now exported to over a dozen countries.
Our Smart Customs Supervision Platform enables a closed-loop customs supervision process, covering everything from cargo retrieval and terminal operating systems and loading onto vehicles to the verification of outbound shipment information. We will also implement a direct release policy for imported zero-tariff goods and bonded goods that are not subject to inspection, quarantine, or licensing controls. The number of declaration items has been streamlined from 105 to 33 to help foreign trade enterprises lower costs and enhance efficiency.
Under the new policies of the Hainan Free Trade Port, faster logistics and customs clearance can help fruit farmers from the Southeast Asia with more problems and earn more money.
Shipping is relatively close and efficient, and the customs procedures are not overly complicated.
In terms of logistics, both delivery time and costs are greatly reduced. Overall, the trading environment there is quite supportive, making it easier to distribute goods into the market.
Hainan Free Trade Port, this testing ground for China's high-level openness, is poised to unleash greater vitality. It is just one epitome for China's long-term commitment to opening up. China now boasts 23 pilot free trade zones, from the free trade zones to the Belt and Road initiatives and the China Railway Express. China's commitment to openness has reached every corner of the world.
But then you start combining Chinese technology. I do think we see a number of countries around the world adopt Chinese tech solutions. And we'd like to have a free trade zone altogether from China.
It's good that China is opening up its markets. It has announced zero tariffs for African countries. I hope they can take adequate advantage of these opportunities so we can trade more. And we hope that countries that are major economies and leaders will continue to find a way to, yes, help solve global problems through international cooperation.
Xu Yi, CGTN, Hainan.
And China's top financial regulators have sent out a consistent signal to address headwinds and curb financial risks. The annual Top Financial Conference, the 2026 Lujiazui Forum, has wrapped up over in Shanghai today. A basket of new measures was sent out, sending out China's commitment to curbing financial risks. Our Chen Tong reports.
At this year's Lujiazui Forum, innovation is the key. A basket of new measures and signals was announced. These new measures include improving the short-term interest rate operational framework, expanding the application of stock market's fifth set of standards to the artificial intelligence sector, and implementing a pilot scheme to facilitate outbound investment with cross-border reinsurance income. An action plan to develop offshore finance at the Shanghai Finance Center was also released. Regulators from China's banking and securities watchdog spoke at the opening ceremony, and their topics range from currencies, foreign exchange, and the stock market. But their addresses sent a consistent message. China plans to strengthen its agenda for expanded opening up.
I think it is really emphasizing on the importance of financial service sector. After all, that is the focus of the Lujiazui Forum. Two is I think China is continuing its efforts trying to be more reforming and opening up with both its financial service sector and overall its economic policy, which I think should be welcomed by the rest of the world.
China has also showed its commitment to curbing financial risks. Vice Premier He Lifeng said that China is committed to forestalling and diffusing financial risks.
Based on previous works and efforts over 3 years, risks stemming from local government debt, regional small and medium financial institutions and real estate have been effectively eased. The number of local government financing vehicles, outstanding operational financial debts, and high-risk local small and medium financial institutions has fallen by 70% versus 2012, some down even more than 70%.
China's economy has long relied on real estate and infrastructure. Yet financial regulators have repeatedly highlighted emerging industries as the next growth driver. For instance, the China Securities Regulatory Commission, the CSRC, backs IPOs of hard tech firms on the stock market. They cover quantum technology, biomanufacturing, and embodied intelligence. Forum participants agree these sectors merit greater investment and policy focus.
China is clearly leading the way, and AI, of course, comes into that as well. So these are areas where we see fast growth in China, which we want to partner with in the City of London.
I think China is really doubling down on its efforts trying to push innovation and technological-driven growth models where we have more and more new startup companies in artificial intelligence, in semiconductor, in new energy vehicles, gradually becoming globally important companies.
Launched in 2008, Lujiazui Forum convenes annually as the key platform for financial regulators to lay out their outlooks. Judging from this year's event, amid economic volatilities, China is proactively rolling out solutions to safeguard financial stability. Emerging technologies, as highlighted at the forum, will be the key breakthrough in the future. Chen Tong, CGTN, Shanghai.
And Shanghai's Lingang New Area has unveiled an expanded pilot program for offshore trade financial services. It follows fresh measures to boost the yuan's global use and manage liquidity, with top regulators at the Lujiazui Forum also authorizing 6 major state banks to conduct offshore yuan transactions in the FTZ. The plan shifts focus from physical goods to digital services like inbound data processing, where overseas raw data is processed into marketable data products through governance, aggregation, and modeling. 4 local banks have been accredited to provide full-chain financial support, moving beyond just simple settlement to cover every stage of the data value chain. Officials say it is an example of full financial support for cross-border digital services.
What we are advancing is precisely the full-chain financial support that takes data from compliant cross-border flows to monetization of data products. In the past, cross-border data in Lingang was more about keeping it under control. Now, we want to make it flow smoothly, be put to good use, and generate real value. Financial services must have the courage to evolve, not only to align with international rules, but also to proactively adapt to the needs of emerging sectors like digital trade here at home.
And up next here on Global Business. The Bank of England held its key interest rate steady at 3.75%, judging inflation pressures too unclear for a premature hike.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business. Only on CGTN.
To monetary policy now, where the Bank of England held its benchmark interest rate steady at 3.75% on Thursday, meeting economist and market expectations. The central bank concluded that raising rates would be premature at this stage, given that the extent of mounting inflation pressures remains uncertain. The BOE's Monetary Policy Committee voted 7-2 to maintain the current rate. On the jobs front, there has been some improvement. Earnings, including bonuses, came in at 3.4% in the 3 months through April, beating expectations as well. The jobless rate fell from 5% to 4.9%, marking the lowest level since mid-2025. Across the Atlantic, the U.S. Central Bank, the Federal Reserve, has also kept its benchmark interest rate unchanged. The Fed believes inflationary pressures linked to the blockade of the Strait of Hormuz will persist at least through the end of this year. Our Owen Fairclough reports.
A new regime starts with nothing new at the U.S. Federal Reserve. Kevin Warsh chairing his first board meeting and a decision to maintain the interest rate that steers the economy at the same level.
The committee decided to maintain the target range for the Fed funds rate at 3.5% to 3.75%.
Surging inflation caused directly by the US-Iran conflict's impact on energy prices is now more than double the Fed's target. But Walsh has argued underlying inflation that strips out big price swings for things like energy isn't as high as conventional measures suggest. That's typically an argument for cutting that rate to gradually bring down the cost of borrowing. But the Fed thinks inflation will remain elevated until the end of the year, and the Board of Governors who vote on monetary policy was unanimous in Wednesday's decision. Walsh's drive to change inflation measurements that can favour low interest rates attracted criticism, partly because it aligns with the view of the man who nominated him, President Donald Trump.
Most of the data that central bankers and other government officials in the United States consume come with old-fashioned survey methods. A national accounts of what the U.S. economy looks like that looks very little like the U.S. economy in 2026.
Trump tried to fire Walsh's predecessor amid constant demands for a lower rate that Jerome Powell largely resisted. And yet those who favour a rate cut can point to an overall resilient economy despite inflation. Retail sales jumped in May, according to data released on Wednesday, following strong jobs numbers and unemployment that remains historically low. Owen Fairclough, CGTN, Washington.
All right, moving now to some other headlines we are tracking at this hour. The Swiss National Bank left its benchmark interest rate unchanged on Thursday, citing that medium-term price pressures had seen little change. The bank has kept borrowing costs at 0%, the lowest level among major central banks worldwide. Meanwhile, Norway's central bank held its policy rate steady at 4.25% on Thursday. However, it signaled that borrowing costs are likely to rise later this year, driven by persistent high inflation. And over in Germany, economic growth is now expected to fall short of earlier forecasts for both this year and the next. That's partly due to higher energy prices linked to the conflict over in Iran. The Macroeconomic Policy Institute projects that Germany's GDP will grow by 0.6% for this year, 0.9% for next year. That is down 0.3 and 0.7 percentage points, respectively, from its March estimates. Well, Africa, too, is feeling the economic fallout from the conflict over in the Middle East. Fragile economies across the continent are facing mounting macroeconomic pressures, including rising inflation and currency depreciation, driven largely by surging oil prices and ongoing supply chain disruptions. Our Uche Okoronkwọ examines both the immediate and long-term implications for African economies.
Like most of its global counterparts, African nations let out a collective sigh of relief at the news of a prospective deal. But that cautious optimism is still wrapped in a fair measure of uncertainty. A deal as soon as Friday is welcome. In fact, economic experts have stressed that the extent of the economic fallout will depend on the war's duration. The UNDP also warned that the longer the conflict lasts and the more severe the disruption to shipping routes and energy and fertilizer supplies, the greater the risk of a significant growth slowdown across the continent. Economic experts say relief may take longer than anticipated. In fact, they warn that the war's long-term impacts may persist even if the agreement holds. They caution that while normalcy may return, flows are not likely to resume to anywhere near pre-war levels for months. The AFDB has said that the backlog of oil and fertilizer supplies could take weeks, possibly months, to recover. Energy experts are also cautioning that restoring full oil and gasoline supplies could take several months. Whenever the strait does reopen, will the speed at which oil and gas production and tanker traffic resume to be able to meet the world's demand? There is an upside. The consequences of the war varies depending on the region. The AFDB forecasts that Central Africa will in fact grow faster this year at 3.8% compared to 3.6% in 2025, and that is thanks to higher commodity prices, especially oil. Well, deal or no deal? The experts say that the shorter-term impact will rely on prudent monetary and exchange rate policies tailored to anchor long-term inflation expectations. And where fiscal space permits, temporary and targeted social protection measures. But in the longer term, all eyes are on the outcome of Friday's signing ceremony in Geneva and what it will signal about an end to this war. Uche Okoronkwọ, CGTN, Africa.
And that's going to wrap up this edition of Global Business here on CGTN. I'm Michael Wong here in Beijing. Thanks for joining us. We'll see you again next time.